Hey everyone, welcome back to Corporate Decoder, the place where we put on our detective hats to solve the mystery of corporate filings. And today, we're diving into a SPAC, a company that is essentially a blank check looking for a business to buy. Get ready because this one has some very interesting layers. So what exactly is this filing all about? Bleichroeder Accession Corp. The second is looking to raise a hefty $250 million in this initial public offering. They are a blank check company, meaning they exist solely to merge with another company. Think of them as a company in search of a purpose. Now this company is incorporated in the Cayman Islands, a common move for SPACs, and they are offering 25 million units at $10 each. Each unit comes with one Class A ordinary share and 1/3 of a warrant. Warrants are like options, they give you the right to buy more shares later at a set price. And here is an interesting detail, they are only selling 1/3 of a warrant per unit. This is to reduce dilution if things go well, which is a smart move for a SPAC, looking to make its shares more attractive to a potential acquisition target. Let's talk about the money raised. They are aiming to bring in $250 million from selling these units, and an additional $7.75 million from selling private placement warrants to their sponsor and the underwriters. This money will go towards finding and closing a deal. Remember, a SPAC has a ticking clock, usually around 2 years, to find a business, or it has to liquidate and return the cash to investors. Now, what kind of business are they looking for? They are focusing on North American and European companies in disruptive growth sectors. Think businesses being transformed by technology where their management team's operational and investment expertise can add value. Their co-founders have serious experience from companies like Sprint and SoftBank, so they bring a lot of knowledge to the table. And they are not new to this game. Members of their management team founded a previous SPAC called Bleichroeder Accession Corp, which is in the process of merging with Merlin Labs, a company focused on autonomous flight technology. That is a good sign that their team knows how to navigate these complex deals. Let's look at the leadership. Andrew Gundlach is their CEO and has a strong background in investment advising, especially with ultra-high net worth families. Michelle Combs, another co-founder, is a seasoned executive having led major tech and telecom companies like Sprint and Altus. Kathy Sabat and Antoine Dessert are both director nominees with impressive track records in executive leadership and board service. This is a team with deep industry connections and a history of high-level experience. One important thing to note is their sponsor Bleichroeder sponsored 2 LLC. This sponsor owns a significant chunk of founder shares and private placement warrants. These founder shares cost them next to nothing, but they represent a substantial ownership stake, and this can create potential conflicts of interest. They get a big payoff if a deal happens, even if it is not the best deal for public shareholders. This is a common SPAC dynamic to watch out for. These founder shares are a big deal. They represent about 25% of the company's shares after the offering, which means public shareholders will see immediate dilution. The sponsor's investment was minimal in comparison to what public shareholders are paying, meaning they have a strong incentive to get a deal done to profit from their initial investment. Here is where it gets a bit technical, but it is important. The founder shares convert into regular Class A shares down the line, but there are anti-dilution provisions. This means if the company issues more shares later for a business combination, the founder shares might convert into even more Class A shares to keep their 25% ownership. This can lead to significant dilution for public shareholders. It is like the founders get a guaranteed slice of the pie no matter how big the pie gets. Now for the risk section, this is where they lay out all the ways things could go wrong. And there are many. Basically it boils down to the fact that they are a blank check company with no real operations yet. Finding a suitable business combination is tough, and if they fail, investors could lose their money. There is also the risk of delisting from NASDAQ if they don't meet the rules, which would hurt the stock's liquidity. Let's look at dilution. The report clearly states that the nominal price paid by the sponsor for founder shares can lead to significant dilution. The sponsor is likely to make a substantial profit even if the acquisition doesn't perform well. This is because their initial investment was so small. They are essentially betting on a deal to close, and their shares are designed to be very valuable if that happens. Turning to the financials, and this is where we get to see the actual numbers, even though they are early days. The company itself has minimal assets at this stage. Their balance sheet shows basically just prepaid expenses and deferred offering costs. They also have a small promissory note to a related party. Their net loss for the period from inception to the 30th of September 2025 was about $25,000. This is basically the cost of setting up the company and preparing for this offering. This is expected for a SPAC that has not yet found a target. Now about where the $250 million will go. A huge chunk, $250 million, will be placed in a trust account. This is basically a safety net for investors. The remaining almost $2 million will be used for operational expenses like legal accounting and travel for finding that business combination. They are also setting aside funds for insurance and payments to their Kuwait affiliate. Let's touch upon the governance. The company is incorporated in the Cayman Islands, and its articles of association have clauses impacting shareholder rights. Holders of Class B shares have special voting rights on director appointments and company continuation outside the Cayman Islands until a business combination. This means Class A shareholders, public shareholders, don't get a say on these critical decisions until after a deal is done. So what is the story here? Bleichroeder Acquisition Corp. The second is a SPAC with an experienced team aiming for disruptive tech companies. They've got a solid chunk of cash ready to go, but like all SPACs, the clock is ticking and the risks are substantial. The founder shares and their dilution impact are a key factor to consider. The sponsor's stake and potential conflicts of interest are also crucial. If they find the right deal and the new company performs well, investors could see good returns. But if they don't find a target or the target struggles, public shareholders might be left with a much smaller piece of what they expected. It is a high-risk, high-reward scenario typical of SPACs, and investors need to understand those risks clearly. Alright, that is our deep dive into Bleichroeder Acquisition Corp. Sakken's filing. What is your take on their strategy? Do you think they will find a great business to merge with, or are the risks too high? Let us know your thoughts in the comments below. If you found this breakdown valuable, hit that like button and subscribe for more analyses like this. And don't forget to join our Discord community for more discussions and insights linked in the description below. Thanks for watching, and we will see you in the next episode of Corporate Decoder.